What's up, guys? My name is Richard, and today we're going to talk about crypto to stable pools. Like any strategy, there is the downside to it, but also the benefit to it. If you guys are yield farming with liquidity pools, crypto and stable pools is a very important tool, but you must understand the downside of it so that you don't lose money while doing it. So before we dive in, here's a quick portfolio update. I recently closed these two positions at a profit in terms of ETH, and I'm at a 10.15 ETH net profit from my closed positions. And you can see my current open positions, I have roughly 9.9 ETH worth of profit right now. So doing pretty well considering how the market has been going. And you can see I'm beating impermanent loss pretty comfortably. So it's better for me to provide liquidity versus just holding these tokens in the market. So let's look at an example of an ETH to USDC liquidity pool. Let's say the green line is your entry roughly at the current price, and the orange lines are your top and bottom range. Let's say $1,000 to $4,000. So in this case, you're going to have some Ethereum and USDC in the pool. And if we hop over to Metrics Finance Pro, let's say I deposit $10,000, you can see I have a minimum range of 1,000 to max price of 4,000. So the yearly APR is not bad, 14-15%, but it's probably higher if I change this custom price to like lower liquidity areas, maybe around here, 28-30%, because Ethereum's price move a lot. And that's typically what I expect from a pretty wide range liquidity pool, roughly 20 to 50% APR, depending on the ranges you set. But the first drawback I want to look at is that your upside is going to be limited. So if we look at the position breakdown, the total value here, we deposit $10,000, right, at this current Ethereum price, which is trading right now just under $1,600. So when I deposited, I would have $10,000. And when Ethereum increase in price, whatever Ethereum I have in the pool gets converted to USDC. So by the time Ethereum, let's say, reaches $4,000, I would only have 13,789. So that's barely a 37-38% gain compared to simply buying and holding Ethereum. So let's say I buy and hold $10,000 worth of Ethereum at this current price, 1,600. I would be able to buy 6.25 Ethereum. And if I multiply that by $4,000 price for Ethereum, then my 6.25 worth of Ethereum would be worth $25,000 at the $4,000 mark. So you can see 25,000 and 13,700 is a pretty big difference. That's the number one drawback of these crypto and stable pools. You're going to have a much limited upside. And if you compare it with crypto to crypto pools like Ethereum and Sol, if Ethereum goes to $4,000, for example, Solana would most likely be over $200 as well. So these two assets would appreciate in value, and none of my assets are being converted to stable coins. So that's the number one drawback. And another drawback is that when the pool exits on the downside, you're at full market exposure again. So here, if the pool is in range, right, you could see I have $3,500 worth of USDC and roughly for Ethereum here. But as the pool goes out of range on the downside, I would have almost 6 or 7 Ethereum. So anywhere in between, my pool is going to be less volatile than Ethereum because I'm holding a portion of USDC. But when the pool exits on the bottom side, you're at 100% full market exposure here. And let's say Ethereum is at $1,000, right? And it drops another 10%, then your portfolio value would drop the same 10% from this point on. Versus if you're anywhere in between, then the amount you're dropping or increasing is going to be less volatile than Ethereum. And this is where a lot of people got in trouble. They set the minimum range, let's say, to 3,000 and the max price is 4,000 when they're yield farming Ethereum. And basically when Ethereum dipped below $3,000, their pool is fully converted to Ethereum. And now you can see Ethereum has lost almost 50% of value from $3,000. So basically after that $3,000 mark, they would have basically been holding the Ethereum all the way down. And just a thought experiment, if Ethereum goes to 0, your pool goes to 0 as well, right? So there's a capped upside, but also an unlimited downside. And the third major drawback is that a lot of these pools will have a lot of impermanent loss. So impermanent loss happens when the price diverges from your entry. Let's say you enter at $1,500, right? Then Ethereum goes up in price a lot, then you're going to suffer a lot of impermanent loss. So if we pull up this Desmos impermanent loss calculator here, I deposit $10,000, right? In this V deposit, price upper is 4,000 like we talked about, price lower 1,000, price now 1570. I deposit at this current price at 1570. So here at the time of deposit, you're going to have 0% impermanent loss. And let's say you change the price now to 4,000, then you can see there's a big impermanent loss at roughly 31%. And if we change to the downside here, let's just say $500 ETH, then again, 38% worth of impermanent loss. So when you have a wide range, it's actually not too bad. But when people set, like, let's say the upper range is at 2,000, right? Ethereum drops to 500, you can see the impermanent loss jumps to 51%. And let's say the price jumps to 4,000, right? And again, you're going to get a lot of impermanent loss on the upside as well. So you could compare here, if you click with these tight range, right? My pool would only be worth 10,464 if I held my liquidity in those two ranges, $2,000 to $1,000. But here, if I just held my tokens separately, then I would have $15,000. And if you have a wider range like we talked about, you're still going to suffer some impermanent loss, because if you just held the tokens, you would have $20,000 worth of Ethereum and USDC if you just held. And with providing liquidity, you're only going to have $14,000, almost $14,000. So just something to consider, but I still use crypto to stable pools a lot of times, especially when Ethereum's price is overheated and I want to bid on more Ethereum. I might swap a lot of my Ethereum into USDC. Then in that scenario, I don't mind some impermanent loss and basically earn fees while I wait. So now that we went over the cons, we're going to look at some of the advantages that these pools have. So the first advantage is there's more reliable cash flow, because when people trade these tokens, these two tokens are what you're earning. And if we're in a downtrending market and you have a pretty wide set range, then only half of your fees are trending down in value. So with these pools, you're earning Ethereum and USDC, right? If Ethereum drops a lot, then half of your fees would be dropping in value, and the other half is just USDC that's staying at $1. If we compare it with ETH and Sol, if the market is not doing well, a lot of my fees would drop in US dollar value as well, because I'm earning Ethereum and Sol in this pool. So this is great if you're generating income to pay for your expenses, because the USDC is not losing value. And the number two advantage is that you're getting pretty decent APR on solid assets. So here I pulled up a Arbitrum and Uniswap ETH to USDC pool. You can see they have the same exact range that I talk about, $1,000 to $4,000. And this pool has been in range for almost 200 days. And if you had that same range over the same time period, you would have gotten like 24% in terms of fees, which is pretty decent for these blue chip pools. And if we look at this tighter range here, $1,500 to $3,000, you can see their APR is much higher, but again, they're at a much higher impermanent loss if the price moves from the time they deposit. You can see they deposit roughly when Ethereum was trading around 2,500, and now it has trended down quite a bit. And the third advantage is that there's lower risk on the underlying assets. So here I'm taking risk on Ethereum and USDC, which are both pretty solid assets. It's not going to be as risky as some of these pools, especially this one that I just got in, right? Like ETH and this base is for everyone token. Even though you could print very high APRs, these assets might go to zero, or stuff like Bonk and ETH. So Bonk is a pretty high market cap token, but still I would consider it higher risk than investing in Ethereum. So you're taking on much lower risk if you're providing liquidity for ETH and USDC. But the main risk is, again, if Ethereum pumps to the upside rapidly, you're going to miss out on a lot of those gains. And the fourth benefit, like we talked about earlier, you're going to have less of a drawdown. If I had this pool here and I entered roughly at $2,200 here, even though Ethereum has trended down pretty sharply, I would have less drawdown than if I just held 100% ETH. The reason why is because like here at this point, probably about half of my pool is USDC, right? And it's being slowly converted to ETH, but you can see if I had this range, I would still have a lot of USDC that's not decreasing in value. So your drawdown would be much lower if you have a lot of USDC on your pool. So if you set the range to 0, for example, the bottom range really wide, you're going to have a lot of USDC in the pool and you're going to have less drawdown. So the last benefit is that there's a lot of flexibility with these pools. I could use it to take US dollar profit when Ethereum is trading high. I could, for example, if Ethereum is trading near $4,000, I still expect some upside. So maybe I would set my top range to be 6,000 and then I would sell most of it to this bottom range at $1,000. If I ran this pool here and Ethereum broke to the upside, that's fine because I got an average sell price of higher than whatever that's above this green line. And if Ethereum trended down, that's also fine because I'm getting a net Ethereum profit when Ethereum trends down because my US dollar is getting converted slowly into Ethereum at a better exchange rate than this green line. So I call this like a bearish bias pool where you sell a lot of your Ethereum and you pair it with USDC, which could be good if you're trying to accumulate more Ethereum on the retrace. So that's the pros and cons. But before we hop off, I want to explain kind of the strategies that I run. So when I consider the prices to be low, typically I'm running like 100% crypto to crypto pools because I'm accumulating a lot of crypto when it's cheap. And when crypto pumps higher, I'm not missing a lot of the upside. But when Ethereum is trading above 2,500, for example, I would probably add some exposure to ETH to USDC pool to kind of take profit and also smooth the volatility of my portfolio. So right now it's 100% crypto to crypto pools. Maybe at 2,500, I would shift to 75 to 25. And maybe at 4,000, I would be 50-50 or more. And another way to run this crypto to stable pool with crypto to crypto pool is basically, let's say you have $100,000, you put $50,000 into a pool right now, right? And this is not financial advice. This is personally something I would do if I have $100,000 to invest now. So here, assuming you're bullish on Ethereum, I'm going to use $50,000 into this USDC to Ethereum pool, either with these ranges or higher on the top side. And basically, when Ethereum is trading above my entry, I'm going to have a positive US dollar divergence loss because my Ethereum, again, that I bought here on this green line is slowly getting converted into USDC at a price above my entry. So when that happens, I could just chill and sell all my fees and just earn a nice income from that. And then another 50% of my portfolio could go into stuff like ETH to BTC or SOL to ETH or smaller altcoins like Bonk or whatever tokens you're bullish on. So another way you could run this crypto to stable pool is by using leverage yield farming, and this would help mitigate some of that impermanent loss. I will make another video detailing this, but basically what I want to do is I want to supply my Ethereum here if I want to have a long Ethereum exposure. So either use the ETH that you have, or let's say you bought a lot of ETH, you deposit here, then I'm going to borrow, let's say $10,000 worth of USDC to yield farm with. And usually when you borrow, you want to keep the loan to value ratio pretty safe. So if I want to loan 10,000 and let's say I only want to loan against 40% of my capital, then I would need to have $25,000 worth of ETH. And then what I'm going to do with that $10,000 is basically stick it into this pool with roughly this range. And you can see if the price moves to the upside, my pool is worth more than $10,000. And if I want to deleverage and pay back my loan anytime, I could do that at an US dollar profit. The downside being that if Ethereum drops in price, you have to worry about this LP value and also your liquidation point. A lot of people make the mistake of lending not enough Ethereum or borrowing too much asset against the assets you're lending. So let's say you lent out 25,000 like we talked about and Ethereum dropped like 50% in price, you're going to be left with $12,500. And that amount you borrowed, right, $10,000 stays the same, assuming you haven't paid any back. So 10,000 divided by 12,500, that's 80% of your collateral. And if you click on this details here, you can see I would be liquidated at 84%. So pretty close to liquidation here. And these are some things to consider before you run a leverage strategy. But these strategies are pretty complex, so don't worry about it if you're a beginner. I'm not running any leverage strategies right now. I will let you guys know if I am running one. And there are a lot of other videos you can watch to basically brush up on liquidity pool yield farming. I hope you guys got some value out of this video. Again, this video is not to say that crypto to stable pool sucks all the time. It's just that if you don't know the downside, then you could miss out on a lot of profit or make a lot of loss when you're doing these pools. Thanks for watching. I'll catch you guys next time.